It is no secret now that interest rate cuts have started, and this is going to impact a number of different stocks and sectors. One of those being small cap stocks. It's going to make it a lot cheaper for them to now borrow money and hopefully speed up growth. It also will impact sectors like utilities, and yes, one of my favorites, REITs. REITs are just another way to add real estate exposure to your portfolio. They're a hands-off approach to real estate. And did you know that prior to the pandemic, REITs have been a top-performing asset class, outpacing the S&P 500 for much of the past 5 decades? So what derailed the REIT train? Well, we had sky-high inflation, which led to very high interest rates, a number of interest rate increases. But all of that is about to change. Investors have been forecasting an interest rate cut for some time now, and we are finally here. But with that forecasting, we have already started to see a bit of a move in REITs. After all, they've been the best performing sector in the S&P 500 for the past few months, but there's still plenty of room. There's a few REITs that haven't fully participated in that run, and in today's video, we're going to be taking a look at 3 REITs to definitely look to add to your portfolio as interest rate cuts come. But before we dive in, do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can check out their 10 best stocks to buy right now by going to fool.com/Mark. You can check out the link down in the description below. All right, let's jump back into today's video, taking a look at 3 REITs to consider buying with interest rate cuts coming. Beginning with REIT number 1, which is EQIX, stock ticker EQIX. With all the talk around AI, many investors have focused on AI chips, AI software, or companies that make AI machinery. But also, and again, if you've been a regular on this channel, you have heard me talk about it. How about AI real estate? As EQIX is the premier data center REIT on the market today. The company currently has a market cap of $83 billion, and over the past 12 months, shares are up 14%. And in the past 4 months, the stock has rallied 27%, and there may be more to go. Here's a look at just a few of the companies that EQIX partners with: Amazon's AWS, Google Cloud, NVIDIA, VMware, Microsoft, Oracle, Cisco, and many more. EQIX has more than 10,000 customers, and no single customer accounts for more than 2.6% of the company's monthly reoccurring revenue. So they're not overexposed to any large technology company. And if you look at the future growth with both cloud and AI being in the early innings, there's plenty of runway for a company like EQIX. In addition, EQIX pays a 2% dividend to go along with a 5-year dividend growth rate of 12%, which is a rarity in the REIT world. The company has grown their dividend for 8 consecutive years and counting. Now let's take a look at valuation, where you can see analysts are looking for the company to generate 2025 AFFO of $37.83 per share, which equates to a forward price to AFFO of 23.2 times, which is still below the company's 5-year average of 26.5 times. At that same 5-year average multiple, that would imply yet another 15% upside from current levels. And that leads us to REIT number 2, which is Alexandria Real Estate, stock ticker ARE. Now, Alexandria is an office REIT, but it's not a traditional office REIT. Even though traditional office REITs have been increasing in value yet again, as we've seen many companies reverting back to 5 days a week for employees to be in office. But again, Alexandria isn't your regular office REIT. Alexandria actually caters to more pharmaceutical-like companies with many of their lab essential infrastructure. The company has strong fundamentals, low debt, and high occupancy. That's a pretty good mix if you ask me. In terms of size, the company has a market cap of $22 billion, and over the past 12 months, shares are up 11%. But on the year so far in 2024, shares are sitting flat. So even though the greater REIT sector has really outperformed and been the top leading sector in the S&P 500 the past few months, Alexandria has not partaken all that much in that rally. giving us another chance with a high-quality REIT with plenty of upside. And the company has done a fantastic job outperforming in the past. The REIT has smoked other REITs within the healthcare sector since its inception back in 1997 by a wide margin, with the exception being only Welltower. When it comes to REITs, it is so important to not only own properties, but own high-quality properties that are in demand. How can you tell this from an investor vantage point? Based on their high occupancy rate. Alexandria has those in-demand products, as you can see here, with their high occupancy rates, with the current year being the highest since the pandemic hit in 2020 at 95.1%. When it comes to the dividend, you don't get quite the fast growth that EQIX pays, but you get a much higher dividend yield at 4.2%. Management has also increased the dividend for 13 consecutive years and counting. Now let's have a look at valuation, where we can see analysts are looking for 2025 AFFO of $7.85 per share, which equates to an AFFO multiple of 15.9 times, well below the company's 5-year average of 27.3 times and well below their 10-year average of 24.2 times. If the company just regained its 10-year average, that would imply a stock price of $190 per share, which equates to huge potential moving forward. Not saying they'll get back to that multiple anytime soon, but we'll see. And that leads us to our third REIT on the list, which is going to be Rexford Industrial, stock ticker REXR. So we've talked about a data center REIT, we've covered a healthcare office REIT, now we're moving to the industrial REIT subsector, which, as you know, is one of my favorites. I love PLD, otherwise known as Prologis within the sector, but right now at current valuations, that's just not a stock I'm looking to add to. And that brings us to Rexford. Rexford has a portfolio of 422 properties, but they take a unique approach in the fact that they focus solely in one area geographically, that being Southern California. And they also appease to small and medium-sized businesses. That could spook some investors given the fact that California isn't known as being the friendliest business state that's out there. But when you dominate the sector as much as Rexford does in their niche, it's going well. Here's a look at the various types of tenants and properties the REIT has, with 23% exposure to wholesale trade, 23% exposure also to manufacturing, and the next largest being 21% warehousing and transportation. A unique blend to say the least, but let's take a look at the company's size and performance of late. The company currently has a market cap of $11 billion, making it the smallest REIT on our list today. And over the past 12 months, shares are just sitting flat, and year to date, a little bit worse, down 9%. Some industrial REITs, even the likes of Prologis, have spoken to the softness they've been seeing in the California region. But Rexford hasn't really been seeing that, and that has been evident by their very high occupancy rate. The occupancy rate currently sits at 97%. And in addition, during the company's latest earnings report, management increased their low-end estimates higher, showing even more confidence moving forward. When it comes to the dividend, the growth has been strong. For a few years at least, as the REIT has a dividend yield of 3.3% to go along with a 5-year dividend growth rate of 18%. But that's a little skewed given the fact that they had to cut their dividend 3 years ago, and now they've increased it quite high for 2 consecutive years. Now let's take a look at valuation, where analysts are expecting the company to generate 2025 AFFO of $2.19 per share, which equates to a forward AFFO multiple of 23.4 times. Extremely well below their 5-year average of 44 times. Now, do I expect a 44 times multiple moving forward? Absolutely not. But when I look at other competitors in the space, many of them trade at the mid to high 20 times range, giving plenty of upside for this amazing REIT. So there we just looked at a data center technology REIT with EQIX. Then we went to the healthcare office REIT with Alexandria Real Estate. And then lastly, we finish it off with an industrial REIT in Rexford, which focuses solely on that Southern California niche. Which of these 3 REITs would you consider for your portfolio? Let me know down in the comment section. If you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.